On June 12th, 2026, something happened that the financial world hadn't seen in over 2 decades. A company went public and raised $75 billion in a single day. Not a typo, $75 billion in one afternoon. For context, Saudi Aramco's IPO, which held the previous record for over 6 years, raised $29.4 billion. SpaceX nearly tripled it. The stock opened at $161, jumped to almost $202 within 3 days, and within 2 weeks, the company had crossed a $2.8 trillion valuation. It entered the top 5 most valuable companies on Earth, ahead of Amazon, ahead of Meta, on the strength of a business that lost nearly $5 billion last year. Let me say that again. $5 billion lost in a single year. And yet here we are. Now, I'm not here to tell you SpaceX is a fraud. It's not. The technology is real, Starlink is real, reusable rockets were a genuine revolution in aerospace. None of that is in question. What is in question is what you actually bought when you bought this stock, and whether most retail investors have any idea what that is. Because underneath the spectacle of the biggest IPO in history, there are 3 specific things about this deal that should make any serious investor deeply uncomfortable, and almost none of the coverage has touched them.
SpaceX just went public. This week, the hype is still fresh. And because of a new rule change by NASDAQ, a quiet little policy update that barely made headlines, SpaceX is now on a fast track to join the NASDAQ 100, which means it will show up inside your index funds, your ETFs, your 401k, whether you chose to buy it or not. This isn't just about SpaceX superfans deciding whether to buy shares on Robinhood. This is about whether an instrument with deep structural problems gets silently embedded in the retirement savings of ordinary people who have no idea it's there. So let's slow down. Let's actually look at what's inside this thing.
Most people picture SpaceX as one company. Rockets, satellites, maybe Mars someday. That's not what you bought on June 12th. What you actually bought is 3 very different businesses stapled together under one ticker symbol, SPCX, 3 months before the IPO. Business 1, Starlink, the satellite internet service. 10.3 million subscribers across 164 countries, $11.4 billion in revenue in 2025. The only profitable part of this entire company. This is the engine. This is the business that actually works.
Business 2, Launch Services. The rockets, Falcon 9, Falcon Heavy, Starship. The legacy that built SpaceX's reputation. Genuinely important, genuinely impressive. Also still burning capital developing Starship, the next-generation launch vehicle that hasn't reached full commercial operation yet. Business 3, xAI. Elon Musk's artificial intelligence company, owner of the Grok chatbot, the X platform, formerly Twitter, and a supercomputer cluster called Colossus. This one was merged into SpaceX in February 2026, 4 months before the IPO, in an all-stock deal valued at $80 billion. That last one is where the story gets uncomfortable.
Let's be precise about the numbers here. SpaceX's AI segment, xAI folded in, generated $3.2 billion in revenue in 2025. It also produced a $6.4 billion operating loss. That's not a typo either. $2 lost for every dollar earned. The AI segment alone burned through more than $6 billion in a single year. And the monthly cash burn coming out of this division is reportedly around $1 billion per month, continuing today. Now, here's where the accounting gets interesting. The $18.7 billion in revenue that headlined SpaceX's S-1 filing, the number splashed across every financial news story, that number includes xAI and X, formerly Twitter, retroactively consolidated into SpaceX's financials because of something called common control accounting, a GAAP convention that lets companies with a shared controlling shareholder restate their combined.
In other words, the revenue figure the market is pricing this company on was assembled by combining 3 separate companies that 6 months ago were 3 separate balance sheets.
Short seller Jim Chanos, one of the sharpest critics of this deal, described the offering as, and I'm paraphrasing, a "don't look at the man behind the curtain" situation. His specific concern? That XAI, which was sold to investors in this deal as a frontier AI company building the next generation of large language models, has actually pivoted into something far more mundane, renting out GPU compute to third parties, a commodity business. 94 times revenue. That is the price-to-revenue multiple implied by SpaceX's $1.77 trillion IPO valuation against $18.7 billion in 2025 sales. For reference, Tesla trades at roughly 8 to 10 times revenue. NVIDIA, the undisputed king of the AI hardware era, trades at a significantly lower multiple than SpaceX right now. Amazon, Microsoft, Apple, all lower on a price-to-sales basis than a company that lost nearly $5 billion last year. Morningstar ran a discounted cash flow model before the IPO. Their conclusion: SpaceX's fair value is approximately $780 billion. That's their number, not mine. The IPO valued it at $1.77 trillion. The stock then ran to $2.8 trillion. That means at its recent high, investors were paying roughly 3.5 times what Morningstar's analysts, using standard valuation methodology, calculated the company is actually worth. Now, to be fair, Morningstar could be wrong. Discounted cash flow models are sensitive to assumptions. New Street Research, an analyst firm that covers SpaceX with a bullish view, published a $165 price target and argued that if you're willing to look out 20 to 25 years, the math can work. 20 to 25 years. That's the honest bull case.
Here's the part that almost nobody in the mainstream financial press is talking about clearly. You do not own SpaceX. You own a piece of paper that represents a financial claim on SpaceX's future earnings, if there are any. But you have almost no say in how the company is run. Here is what the S-1 actually says, in plain language. Elon Musk owns approximately 42% of SpaceX's equity. He controls 82% of the voting power. This is achieved through a dual-class share structure. Class A shares for the public, which carry 1 vote each. Class B shares held by Musk, which carry 10 votes each. What this means practically: Musk can unilaterally approve mergers. He can approve executive compensation. He can approve any strategic pivot, including ones that benefit his other businesses, without asking you. The S-1 explicitly states that SpaceX is a controlled company under NASDAQ rules, which means it gets to bypass certain standard corporate governance requirements.
The XAI merger? Musk decided that. You didn't vote on it. Neither did any board committee with meaningful independence. Harvard Law School's Program on Corporate Governance published an analysis of this structure before the IPO. Their concern was specific. Because SpaceX shares will likely represent a majority of Musk's wealth, he now has an incentive to use his voting control to move value from his other companies, Tesla, Neuralink, the Boring Company, into SpaceX, or to move value out of SpaceX and into those companies, depending on which direction benefits him personally at any given moment. That's not an allegation of wrongdoing. That's a description of a structural incentive that the governance setup makes difficult to challenge in court. Step back and look at what just happened. A company with $18.7 billion in revenue, a $5 billion net loss, and a business model that depends on assumptions extending 2 to 3 decades into the future, just completed the largest capital raise in the history of public markets. It did this during a specific window: a bull market for AI infrastructure, peak enthusiasm for the intersection of space and technology, a regulatory environment friendly to Musk-affiliated entities, and a new NASDAQ rule that accelerates index inclusion for large IPOs. The window is now open, and as one market observer noted after the IPO, this opening means other companies will fly through it. OpenAI, Anthropic, other private giants that have been holding back. Each of these companies will bring its own version of this story. Asymmetric governance, speculative revenue multiples, businesses stapled together months before going public. The same pattern, different name on the door. The retail investor, The ordinary person who buys through Robinhood or whose 401k manager is now required to hold SPCX as a NASDAQ 100 constituent is at the end of this chain. Starlink is genuinely important technology. SpaceX has a real and defensible lead in commercial launch capacity. These are not nothing. The bull case exists. But there's a difference between a company being impressive and a company being worth $2.8 trillion to buy today, with no voting rights, while the controlling shareholder is simultaneously running an AI company, a car company, a social media platform, and a neurotechnology startup. Here's the thing that I keep coming back to. SpaceX kept Elon Musk as CEO throughout this process, and Musk himself, in the days after the IPO, posted on X that SpaceX might be able to reach approximately $1 trillion in revenue in 2030. Might. Approximately. 2030. 4 years from now. The company earned $18.7 billion last year. To reach $1 trillion in 4 years would require roughly 53x revenue growth. That's the dream being sold. And when you look at the price to revenue multiple investors are paying, 94 times, you realize that dream is already priced in, multiple times over. So here's the question I'll leave you with. What happens to the stock when the dream slows down? Not fails, just slows. What happens to a company priced for $1 trillion in revenue by 2030 if it hits, say, $60 billion by 2030, which would itself be extraordinary growth? Nobody at the IPO roadshow asked that question. Nobody in the frenzy of the first 3 trading days was thinking about it. But that question is sitting quietly inside every index fund that bought SPCX last week, inside every retail investor who bought at $192. And it's not going anywhere.